Welcome to Course 3, Unit 1, Lesson 1, When to Sell Stock. For a lot of people, selling stock is kind of a mystery game for them. It's almost like they're rolling the dice of whether they should continue to hold, sell, buy more, buy something else. And hopefully this lesson for the start of Course 3 will help you easily determine whether you should sell shares, buy shares, or whatever. So let's get started, and I'll take you through the methodology. One of the things that Buffett does really well is he knows when and if he should ever sell shares of stock. Now, whenever he buys his stock, he always has the opinion that he plans on owning it forever. So his intent is never to buy something low and then sell it when it's high. His intent is to buy it low and to continue holding it throughout the life of the business. But in some situations, he does need to sell his shares, and it typically always revolves around two rules. So the first rule that he has is he'll sell the shares if he can expect a higher return by trading into another asset. And what he takes into account when he conducts that transfer is that he has to account for the capital gains. And something else that I'd like to add is not only does he account for the capital gains he's going to pay and that he's going to lose when he transfers assets, but he's also taken into account the level of risk as he moves from one asset to the other. So he's going to want to find something that's of similar risk if he's going for a comparable return after paying the capital gains tax. So that might sound a little complicated, and that's what this entire lesson really focuses on, is determining that change and whether it's worth the trade. And then the second variable that he uses when determining whether he should sell something is if the company has changed its fundamentals. Back there in Course 2, Unit 3, we discussed his 4 rules for buying common shares, and all those different principles, those tenets, if any of those tenets change after he has purchased the shares, that alone is reason for him to go ahead and sell the shares. So let's say that you bought a company that really managed their debt well, and they kept the debt to equity below 0.5, and they had a current ratio above like a 1.5 and things like that. Let's say 2 or 3 years down the road, the company doesn't possess those fundamentals anymore. Well, that's a very good reason for you to sell those shares, regardless of what the trading price is, because that company has changed the way that it's operating, and that's something that you might want to run away from depending on which direction the change is going. So let's go ahead and focus on that first tenet, where we're going to basically figure out how to assess that change in value from one asset to the other after we account for capital gains tax. Okay, so I'm going to give you a scenario, and this is just a generic scenario. It doesn't really have anything to do with the current market trends of how low it was in 2009 or anything like that. So don't read into that too much. Just kind of look at the pure numbers, because that's what I'm trying to get at here. So I'm gonna lay out a scenario for you where there's one share of a company, and the ticker for that company is XXX. Okay, the market price of company XXX is $50 a share, and the book value for that company is $48 a share, which is really close to the market price. And you have gone through all those different techniques that we learned back in Course 2, Unit 3 to assess the expected book value growth and all that stuff that you can calculate the intrinsic value. So I'm showing you those key terms that you need to know in order to figure that out. So the expected book value growth on this company, based off of past performance and future earnings and all that, is going to be 7% annually. Now, I know I've told you in the past that you always want to buy a company with dividends, but in order to make the calculation a little easy, I've just kind of said that we're not going to deal with any companies that are paying dividends. We're just going to assume that all the earnings that the company makes is going to be put back into the equity of the business, which will be displayed as book value. Okay, and that's grown at 7%. And this company's debt to equity ratio is right where we want it, or at a 0.5 or lower, so it's right on target there. And our future earnings are going to be consistent to what we've seen in the last 10 years. So based on those figures, when we compare XXX to, let's say that the 10-year federal note right now is 3%, even though that's not what it is, we're just going to say that for this generic scenario in year 2009, which was 3 years ago, let's just say that the interest rates were 3%. So how would we calculate the intrinsic value on that company right then and there? Let's figure that out before we move on to the next scenario. So I'm going to pull up the Buffett's Books intrinsic value calculator in order to do that quick calculation. Okay, so I have the buffettsbooks.com website pulled up, And in order to go to the intrinsic value calculator, the first thing we're going to do is we're going to go over here and hover our mouse on the calculators tab. We're going to come down to intrinsic values and stocks. Okay, and it takes us directly to our intrinsic value calculator, which is all you have to do is scroll down. And based off the information that I gave you, you're not going to really have to input anything on the top calculator because I already gave you what the expected book value growth is going to be. So we can come down here to the lower calculator, and we can see that all the numbers that we need are already there. Okay, so the cash that's going to be taken out of the business, we said that the dividend is 0, so we'll put that in there. Okay, that's our expected dividend over the next 10 years. The current book value is $48, so we're going to go ahead and put that in. The average percent change in book value per year. So this is the number 7% that we have right here. This 7% annual growth is how much we think that $48 book value is going to grow by each year for the next 10 years. So we're going to put 7 in there, which means 7%. And then what we're going to discount it back off of is going to be the 10-year federal note. So it's going to go for 10 years, and we're going to use a 3% federal note, and we're going to calculate the intrinsic value. Okay, and as you can see, we got $70.25. So we're just going to round this off to, let's just say the intrinsic value of this company is $70 a share. Now, if any of what I've just described doesn't make any sense to you, you're probably going to want to go back to the Course 2, Unit 3, Lesson 5 in order to really understand how that intrinsic value calculator works. So after running all those numbers through our intrinsic value calculator, we know that company XXX, which is trading on the market for $50 a share, we believe its value to be worth $70 a share when we compare it to a 3% federal 10-year federal note. Okay, so when we look at that, let's assume that we would go ahead and buy some shares of this company because it was at a decent price. It was trading for 50 and we think it's worth 70 when comparing it to the note. So let's just say we buy 1,000 shares of company XXX, and we purchase those shares at $50 a share. So therefore, this is a $50,000 investment that we just made in this company. Okay, so that's the company that we own. And what I'm going to do is now I'm going to walk you through a sell scenario. Let's go ahead and warp in time to 3 years later. And let's see how our investment did and whether we want to continue to hold it or maybe buy something else. Okay, so we've owned company XXX for 3 years, okay, and time has progressed in an unusual way, and our company really hasn't performed like we had expected it to. Based on all those numbers, we really thought XXX was a strong pick, but in the end, it's kind of showing some really weird signs. So let's go ahead and walk through those. So the first thing that we're going to naturally look at is the market price. When back 3 years ago, whenever we bought company XXX, the market price was $50. But now we were very fortunate, and the company's actually trading on the market for $70 a share. So that was very fortunate. I mean, that was kind of where we predicted the price to be. But let's see if it's actually worth $70 a share. Just because it's trading there doesn't mean that it's necessarily worth that. So when we go down and we look at the book value of the company, which is 3 years later, we see that the book value is the same amount that it was 3 years previous, which is kind of strange, especially because this company hasn't paid any dividends. So that's kind of a bad sign that the book value really hasn't grown. You would think that the market price would have trended with the book value, but it didn't. As we look at the expected book value growth right now, it's now at 5%, which is considerably lower than where we thought it was 3 years ago. The dividend is still 0, and as we looked at the debt to equity number, we can see that it's much, much higher than where it was. It's at a 3.0, and that number is not good. That number is pretty scary, and to be quite honest with you, we could go to that second tenet where this company has changed its fundamentals with the way it manages its debt, and we would actually probably maybe disregard the company and sell the company specifically for that reason alone. Okay, now the last thing that we're looking at is probably the most important factor of them all, and that is that the forecasts for future earnings are consistently getting lower. Okay, in the previous scenario, when we bought this company 3 years earlier, those earnings were consistent and constant with the previous 10 years, and the forecast for the future was the same type of earnings. But now the earnings are actually decreasing. And so between that and the debt to equity being a little higher, that would be reason alone to sell this company. But in order to show you the math behind this, because it might not be as blatant with some of your picks, so I'm going to show you the math behind this so that we can figure out whether we should sell the company, trade it into something else, buy a 10-year federal note, or whatever the case might be. Okay? So when we look at the value of the company today, which is 3 years later, it's going to have a completely different value than we had 3 years earlier. And that's what we're going to figure out with the intrinsic value calculator again. So let's go ahead and let's figure out what the intrinsic value of the company is today. And when we look at the 10-year federal note, let's just assume that the 10-year federal note is now 4.5%. Now, if you remember before, it was 3%, but now it's 4.5%. So that's going to put a different intrinsic value on this company, especially because our market price is different and all those different variables. Okay, so let's go back to our intrinsic value calculator and let's figure out what this thing's worth with all the new variables. Okay, so here we are back at the intrinsic value calculator again. You take the same path that we took before to get here. When we look at the cash that can be taken out of the business, it's still going to be zero because the company's not paying a dividend. Now, when we look at the current book value, it's still the same because the book value, the company didn't add any money to the book value. Now, you might be wondering why the market price has increased to $70. And you know what? A lot of the time, some of this stuff just won't even make any sense at all. Like, why did the company increase in value when the book didn't grow and they haven't paid a dividend? I can't explain that, and a lot of the times you won't be able to explain it, but that's besides the point. Sometimes these markets move in directions you can't even make conscious sense of it, but what you can do is you can value it. So that's what we're doing here. Okay, so the book value is still 48. Now, the average percent change in book. Now, right now we're assessing that the book value is only going to grow 5%, where before we were saying it was going to grow at 7%. So that's a major difference, and we've got to put that change in. So we're going to change that to 5, okay, which is symbolic of 5%. We're still going to have the calculator sum it over the next 10 years because then we're going to compare it to the 10-year federal note. Now, before the 10-year federal note was at 3%, but now it's at 4.5%. So that's going to change the value of our company. So we put 4.5%. And just remember that 10-year federal note is nothing more than a ruler. That's a measuring stick for a zero risk investment that you could put your money into. And that's why you're comparing it to that 10-year federal note. Okay, so we're going to go ahead and click calculate. And you can see that the intrinsic value of this company has drastically changed from where we were at 3 years earlier. So now the intrinsic value on this company is $50 a share. And on the market, you can see that the market price is $70 a share. So the intrinsic value is much lower than what the company's actually trading for, okay? That's not a good thing. That means that if we continue to hold it, we're going to be losing money, okay? So to answer our question down here, to calculate the intrinsic value of one share, we think it's now worth $50 a share when we compare it to the 10-year federal note at 4.5%. Not only did we find the intrinsic value to only be worth $50 a share, but we also have that debt to equity issue, and we also see that the future earnings are consistently getting lower. So these are all signs that you would potentially want to sell this stock. Okay? So when you want to sell a stock, you have to have something that you want to put it into. You have to be able to put it into something else. So our natural inclination is that we could immediately put it into a 10-year federal note and probably get a better return than where it's at right now, which we haven't done the numbers on that. But if we did, I would pretty much assume that the 10-year federal note would give us a better return if we transferred it out of this company. But let's go ahead and look around the market and see what other types of companies we have that we could potentially trade this for and get into. Okay, so here's a quick recap. In 2009, we're going to assume that that's when we purchased company XXX, okay? We bought it at a market price of $50. We thought that the intrinsic value was $70, so we bought 1,000 shares, okay? 3 years later, we still own the same company, and the market price came up to $70 a share, but then the intrinsic value went down to $50, and we still own those 1,000 shares. So right now we're in a position where we're looking to maybe transfer that money, those funds, into something else that's more lucrative. Okay, as we look around the market, we find that companies are trading for pretty much a high premium across the board. You're most likely in a bull market at that point. So if you're looking around the market and you're having trouble finding anything that's giving you a good intrinsic value versus the market price, you're probably in a bull market. Despite those conditions, we stumble across a company called TTT, okay? And I'm going to show you the numbers on TTT. Okay, so one share of company TTT. We're going to say that the market price on TTT is $50 a share. We're going to say, just by coincidence, that the book value for this company is also $48 a share, just like the last company, okay? And our expected book value growth is 6% with company TTT, which is 1% higher than what we had with company XXX. This company also doesn't pay a dividend, but the debt to equity is at a 0.5, which is much better than company XXX right now. And the forecast for future earnings is the same as the last 10 years. So that's the good sign. Company TTT has a good debt management. Their future earnings are all looking good, and the book value growth that we've estimated is a little bit higher than the company we're currently holding. Okay, so when we compare company TTT to a 4.5 10-year federal note, what's its intrinsic value? So we're going to go back to the intrinsic value calculator. Okay, so we're going to go ahead and put these numbers in. So there's no dividend payment. The book value on company TTT is also $48. Just by coincidence, it could become something completely different, and you'd still be able to figure all this out. Okay, and our percent change in book, we're saying, is going to be 6%, okay, which is 1% higher than the last company. Okay, then the years we're going to own it is 10, and the 10-year federal note is still 4.5%. So let's go ahead and figure out what company TTT's intrinsic value is. Okay, it's $55, okay? And it's trading for $50, so that's a good thing. We're able to buy the company for lower than what we think the intrinsic value is. Okay, so our intrinsic value on company TTT is $55. Okay, so here's the point of this entire exercise, okay? When you look at all those variables, it might be difficult to understand what in the world do you do. Do you continue to hold the company that you bought 3 years ago because you've made substantial gains and you might not want to pay capital gains tax to get out of it and transfer it into something else? Or do you just sell it and do you transfer the money into TTT, or do you buy the 10-year federal note? And so there's a lot of variables here, and for a lot of people it might get confusing. And so what I'm going to do is I'm going to walk you through a step-by-step method so that you can determine what you should do in a situation like this, okay? Because you're going to be faced with this situation the more that you trade stock. So the question is, do you continue to hold company XXX, or do you sell your shares, pay the capital gains, and purchase company TTT? Okay, so that's our question that we're going to solve here. Okay, so here's another quick recap so that you're on top of everything that's happened up to this point. So company XXX, our market price is $70 currently. The intrinsic value, we calculated it to be $50, which is significantly lower than what it's trading for. That's not good. We own 1,000 shares. So we've made a $20,000 profit by owning this company for that duration of 3 years. Okay, so that's what we're going to pay capital gains tax on if we decide to get out of that asset. So company TTT, the market price is $50 a share, and the intrinsic value that we just calculated is $55 a share, which is good because that's $5. We're able to buy that for $5 lower than what it's actually worth. Okay, and that's how you need to look at that. And we don't own any of these shares yet, and we need to determine whether that's a good buy or not. Okay, so how we're going to solve this problem is a 3-step process. First, step 1, how much of a return do we expect to make with our current stock? Okay, so if we continue to hold XXX for the next 10 years, what is that money going to turn into? That's our first question that we have to answer. The second question we have to answer is, how much do I have to invest in the alternate stock after I pay the capital gains tax? Okay, because once we know that, then we know how many shares we can buy, and then we can estimate how much it's going to be. So step 2 is we have to figure out how much money we'll have after we pay the capital gains tax. Step 3 is how much of a return will we get from the new pick? Okay, so after we figure out that capital gains problem, we then have to take that money and pretend we buy company TTT, and then we have to estimate how much that will grow to over the next 10 years. And then what we're going to do is we're just going to compare number 1 and number 3 to see which one's a more lucrative pick. So let's start off with step 1, okay, the return on our current pick. Okay, so we figured out what the intrinsic value is, but what kind of return are we going to get if we continue to hold those shares considering the market price says it's trading for $70, but we feel it's only worth $50. So if we continue to hold those shares, how much of a return are we going to get over the next 10 years? So let's go ahead and solve that problem, okay? So in order to solve it, we have to go back to our intrinsic value calculator. Okay, so here we are with the intrinsic value calculator. And what we're going to do is we're just going to fill out these numbers. And the first one, the dividend is 0 because we don't have a dividend. The book value is still $48. The percent change, we only think that the book value is going to grow by 5% a year. The number of years is 10, and then the 10-year federal note is 4.5. So when we hit calculate, it comes up with our intrinsic value of $50, okay, which we already figured that out, okay. So in order to figure out how much we think we would get over the next 10 years, all we have to do is we have to adjust this number. Instead of having 4.5% in for our 10-year federal note, we're going to adjust that number until our intrinsic value equals the current market price, okay. So our current market price is $70, okay? So I have to adjust this number here until the intrinsic value equals $70, or pretty close to it, okay? So let's go ahead and just try 3%, okay? Let's go. We want to go down because the market price is higher than the intrinsic value, okay? So we're going to go ahead and hit calculate, and we see it's at $58. Remember, we want this to equal 70. We don't stop until it equals 70. So let's try 2%. Hit calculate, now it's $64, okay, so we're getting closer. So let's hit 1. And when we use 1% as our 10-year federal note, okay, it shows that our intrinsic value is $70, okay, which matches the current market price. So when these two numbers match, when we have the intrinsic value equals the market price, we know that we're going to get the same return as what our input is for the 10-year federal note. And since we put 1% in there, that's how much we're going to make if we continue to hold company XXX over the next 10 years. So annually, you're going to make 1% if you continue to hold this company. So that's some pretty bad returns. That's something that you're definitely going to want to try to move out of if you have an asset like that. So to answer our question on the bottom, we're going to make a 1% return annually over the next 10 years. Okay, so how much would that 1% turn into with our current investment? So we know we have 1,000 shares of company XXX, okay, and when we take 1,000 shares times the $70 a share, we know that that it's worth $70,000 right now. So what will be the value of those shares in 10 years? So in order to do that little problem, we're just going to use our future value of money formula, okay, which FV is the future value, and that's equal to our present value times 1 plus I, which is our interest rate, raised to the number of years, okay? So in this scenario, our present value is $70,000. Our I, or our interest rate, is going to grow. That's going to grow 1% annually, okay? And we're going to do it over the next 10 years, okay? So we're going to look at what the value of these shares would be in the year 2022, okay? So when we do that math problem, make sure you do your exponent first. We come up with $77,323.55. So that's what that investment's going to grow into if we just continue to hold company XXX. Okay, so let's go on to step 2. In order to go to step 2, we have to be able to pull up what the capital gains tax rate you're going to be in. So for this company XXX, we made a $20,000 gain on this company in a 3-year time frame, okay? Now, as you look at the chart there, I have the chart up for 2013. Even though it's technically 2012, I'm using the numbers for 2013 because I feel that might be a little bit better as this video becomes a little bit old over the next coming years. The chart will be valid, okay? And if you're reading my book uses the numbers from previous to 2012, so you're going to see the numbers differ a little bit from the book to this video. So as we look at those numbers, this would be considered a long-term capital gain. So as you look at the chart, you have short-term capital gains, which is less than a year. Long-term capital gains is more than a year. And then you have the 5-year capital gains rate, which is a little bit better. You could get into the 8% and 18%. And remember, this is only for 2013 and beyond. So for our scenario, we fall into that 10 to 20% long-term capital gains range, depending on what your ordinary income tax bracket is. So let's go ahead and assume that you're in a tax bracket that's higher than 15%. So the capital gains that you'll pay is 20%. Okay? So in order to figure out how much federal capital gains tax you'd pay, you just take your 20% times your gain of $20,000, and that comes out to be a 4% federal capital gains tax. Okay? So once we make that payment, we know we only have $66,000 left from the original $70,000 in order to invest that money somewhere else. Okay? Since we're changing assets, we pay the capital gains of $4,000, and then whatever's left is what we can invest in the next asset. And so since we're trying to invest in company TTT, we know we're only going to have $66,000 to invest in that company. So this is something that's really important that you have to account for, because a lot of people might see, oh, well, you're getting an extra % more by transferring it into another company, but yeah, you have to pay the capital gains. And so once you do that math, it might not make sense for you to change into the other asset. Now, this is something that's really important, and I want you to remember this. I'm only doing the calculation for the federal capital gains tax. When you're doing this for real, you're also going to have to account for more money that you might have to pay to the state. So these are all considerations that you really got to make as you're looking at transferring asset from one asset to the next, that you're paying all this money in federal and state taxes before you do the math on how much it's going to grow. Okay, but just to keep things simple, we're just going to assume that we paid federal taxes and that's it, and that the rest of the money that remains, we're going to see what will happen if we put that money in the company TTT. Okay, so the first thing we have to do, and this is step 3, what is going to be the return on our new pick? So we have to figure that out. How much are we going to make once we take our $66,000 and we buy company TTT? So in order to do that, we come back to the Buffett's books intrinsic value calculator. Okay, and what we're going to do is the cash taken out of the business, no dividend is being paid. Okay, so that's going to be 0. The book value, just by chance, is still $48. Almost always that'll be different from your previous pick, so that's just pure coincidence. When we look at the average % change in book, this is a little different. This company TTT is a little bit higher at 6%. Okay, the number of years is still going to be 10, and our 10-year federal note, if you remember, is still 4.5% currently. So we're going to go ahead and hit calculate. And if you remember, this is how we figured it out earlier. It's $55. The current market price is $50. Okay, so we've got to change, just like we did before for company XXX. We've got to change this 10-year federal note until the intrinsic value equals our market price of $50. So in order to make this number go lower, we have to make this number of our 10-year federal note larger. Okay, so let's go ahead and make it 5% and see what happens. Okay, we're getting close. It changed the intrinsic value to $52. We want it to be 50. We're not going to stop until that equals 50. So let's go ahead and try 5.5%. Okay, and when we put 5.5% in here, we got the intrinsic value to equal the current market price of $50. So we know that if we're going to buy company TTT, that we're going to get a 5.5%. That's what we estimate, that we're going to make a 5.5% return at that current market price. Okay, so we answered that question for our step 3. And we now know that if we buy company TTT at the current market price, we're going to make 5.5% annually over the next 10 years. That's what we estimate. Okay, so the final step, we just got to figure out how much will that investment of $66,000 turn into if it grows at 5.5% a year. So we go back to our basic formula. And just so you know how many shares we'd be able to buy, you're going to take your $66,000 divided by your $50 per share, and you'd be able to buy 1,320 shares of the new company. And those shares would grow. So our present value is $66,000. It's going to grow at 5.5%. So when we plug those numbers into the formula, our future value equals $112,737. And that would be the value in 10 years from now, which the year would be 2022. So let's go ahead and recap what happened here. Okay, if we decided that if we continue to hold company XXX based off of all the new trends in the data, that our future market value in 10 years would be worth $77,000. And then we went and calculated, after we pay the capital gains that we earned off of company XXX, and then we traded it into company TTT, that the future market value would grow to $112,000 in that same time period. So the smart decision here for the intelligent investor and the person who understands security analysis is that their decision to transfer the money and to sell their shares of company XXX and trade them into company TTT is a $35,000 decision. So this concludes Course 3, Unit 1, Lesson 1, When to Sell Stock. I hope the information has been informative, and I look forward to seeing you guys in the next lesson.